What is going on, guys? We have a juicy video for you guys today. We're going to be talking about two fantastic stocks and pretty much in the same sector. They have the same business model with a couple differences. FinV and QFIN. So I was looking at one of the hedge funds, one of the asset management companies, Greenwoods, and they have bought more QFU recently, and that is how I found out about QFU. They do buy mostly Chinese companies, but they have a lot of Mega 7, Meta, Microsoft, and whatnot. And QFU is now 2% of their holdings. So this video was originally supposed to be only about Kifu, and then when I was just about to start recording it, I was going through the competitors and I found FinV, which is pretty much the same company but is growing a lot nicer, projected a lot more growth, but being a little less profitable than Kifu. But look at these charts; both of these companies are very profitable. They both pay a dividend, a very safe dividend. If you look at their dividends for Kifu, they only have to pay 17% of their free cash flow to pay off the whole dividend, which is at 5%. Compared to FinV, they have to pay 30% of their cash flow. And both these companies are doing a lot of share repurchasing. So both these companies are very friendly to shareholders. And one thing that I like to point out is that FinV has a lot more insiders holding the company. They have 20% of shares held by insiders and only 53% by institution, when QFIN has only 1% insider holdings and 68% of institutional holdings. And if you look at this chart, this is FinV is the green one, and we can see that recently QFIN has had a lot bigger spike and is up 90% in 5 years compared to 41% on FinV. So let's take a look at the balance sheet really quickly. Both have a really healthy balance sheet. FinV's has more assets than liabilities. Both the guys hold a lot of cash. Both companies have zero goodwill, zero intangible assets, and total liquidity for FinV is about $1.1 billion. They both have pretty much the same amount of cash. They both have 4 billion, but this is you got to keep in mind this is Chinese yuan, so most of the numbers are in Chinese yuan. I will translate them to USD. So 5 billion, that's about 700 million USD dollars. And if you look at the market cap, and I just want to point out to you guys that why I think FinV is a lot cheaper, and we can just look at these stats and it'll point it right out. Both the companies have very low debt. They're both fintech stocks, kind of like SoFi, but they have less risk than SoFi because what they do is they connect the consumer to the financial institutions. They have partnered with a bunch of financial institutions, and Kifu uses a lot more AI when FinV uses more advertising and whatnot. FinV has been around longer. They were founded in 2007 when Kifu was founded in 2016. SoFi was founded in 2011 and are still not profitable because they have a little bit of a different model, but both these companies are very profitable and working on that. And I was listening to the earnings report for Kifu, and they mentioned that they want to tighten overall credit standard, and their top priority was improving asset quality. So they just want to become even more profitable. Both companies are doing the same thing. We're gonna go look over their investor presentations, and we're gonna take a look at that. But both these companies are trading at a 5 price to earnings, which is very cheap. Kifu has a double market cap of 3 billion compared to FinV, which has only less than 1.5 billion. And we can see the forward price to earnings is only 3 for FinV, and trading less than 1 book value, 0.75, 0.86 sales. And we can see they both have a lot of cash, and they both have a very low debt, only $38 million in debt for FinV. And if you look at Kifu, they have more debt. They have 854 million, but they do have a lot more assets as well. So we have to keep that in mind. And yeah, they're both very profitable. I don't know I believe we looked at a dividend. Now let's look at the growth. So if you look at why I like FinV is they're projected a lot more growth. They're supposed to grow 4% compared to 2023 for full year 2024 and 8% 2025. Kifu, their revenue is supposed to go down for full year to 2024, which is okay because their earnings are still growing and they're becoming more profitable. And next year, they're projected to grow 4.6%. That's what the analysts are saying. Now, let's dig into the presentations. So what do they do and how are they different from one another? So if you look at this is the annual report for Kifu. And if we zoom in here, we can kind of see what they do. So number one, I believe they wrote down stages as well. So they find the credit application, they find the right consumers and these guys Kifu work with SMEs. SMEs are small to medium-sized enterprises, or small and medium-sized businesses, and they find the ones that are eligible for credit and the right match for the right institution, and they kind of connect the two, and they get a fee from it. They get a service fee, so they don't. Usually, they do as well put some collateral as well and risk their own credit, but mostly they just connect the two and they profit from it. So they have service fee, and then the borrowers also repay the financial institutions, and QFIN just collects a service fee, which has been doing fantastic for them. So one thing about Kifu is they're both these companies are based in China, but FinV is expanding. They now almost 20% of revenue is coming from internationally from Indonesia and Philippines, and still 80% is coming from China. So again, this is FinV. Their top player, most of the revenue is coming from China, but also Indonesia and the Philippines. So they have platforms in all three countries and are growing in all three countries. And one thing that I like also, if you look at Kifu, 70% of their borrowers are under 40 years old and a lot of repeated borrowers. So these are most likely going to be lifetime borrowers that use Kifu and use FinV to get their loans. And the average age for FinV is even younger. So average age in China, 25 to 34. And you can just look at this. They're all under 40, the average age. And one thing that's like a lot different from SoFi as well, that because SoFi, most of their revenue comes from North America, where annual income is, I believe the annual income is around $30,000 to $50,000 US, when China is 8,000 to 17,000, and Indonesia is only $2,000 to $4,000, and Philippines only the same, up to $5,000 of annual income. That is insane. Just be grateful, guys. So customer acquisition through diversified channel. So again, this is FinV. They do online advertising, SEM, search engine marketing, app stores, customer referrals, and they also have a direct sales team. Their average loan tenure, which is pretty much the length of the loan, is 8.2 months compared to Kifu, which is around 10 to 11 months. And I believe they both use AI as well. They look for anti-fraud, that they match the right consumer. They give them a credit scoring and an assessment. They do then they give them the loan, and then they do the post facilitation monitoring and the loan collection. And this is a great graph that I really like to see in FinV. If you look at the shift towards better quality borrowers. So if you can see all the colors right here, it's only 1 and 2 credit rating is the majority. Over 80%, almost 90% of the borrowers are in sector 1 and 2 of credit scoring, which means they have better credit score and higher chance of paying back the loan, which is very important compared to 2018, where that was only 15%. So these guys are doing a great job this is going to result in better profitability, less delinquency rate. So delinquency rate is loans that have not been paid back on time that are late, which is only under 3%. And I believe for Kifu, it's around 4.5%. So, which is a little better than Kifu. And yeah, so they pretty much connect the borrowers to the financial institutions. They have a great management team. If you look at this, these guys worked in Microsoft, some Chinese companies that I have no idea about, but Microsoft, that we like to see. And these guys look pretty young, if you ask me. So yeah, that's pretty much it. If you look at this, transition to better quality borrowers. So revenue from international markets, 18.8%, which has been growing nicely, and which I like because Kifu is only based in China, which is not a bad thing, but would like them to grow internationally. So yeah, pretty much transition to better quality borrowers. So they're okay with slowing down revenues for a little bit to get better borrowers, better quality assets, better profit margins. And then yeah, if you look at Kifu, pretty similar. They're partnered with 160 financial institutions, so banks, national banks, regional banks, and whatnot. They have 52 million cumulative users. They have 52 million users compared to FinV. FinV has a booming 185 million users. So FinV has a lot more users, but if you look, a lot of the users is coming from Indonesia and Philippines, which have lower annual incomes, who need less money and can only pay back less money. So that's why they need higher user growth to get more revenue from them. So yeah, and again, FinV has 1.1 billion in total liquidity, and they have $1.4 billion market cap. That's a steal. They're selling less than book value. Both these companies are very profitable. They both do share buybacks. So if you look at some of the news in Kifu, you can see that in 2023, they announced a share purchase plan of $150 million, which as of March 2024, they already paid off. And then they still think the company is selling cheap. So they announced another share repurchase plan of $350 million starting from April 2024. And they have 12 months to spend $350 million in buying back shares. And FinV has been doing the exact same thing. And I believe FinV has been doing it even better. And if you look at the diluted shares outstanding, this is yearly, from 1.5 billion in 2019 to 1.4 billion in 2023. And if you look at the quarterly, we just see a beautiful rolling downhill, and love to see it. Compared to QFIN has been doing the same thing, but not as religiously. Now they are 350 million share purchase plan. These will go down. The outstanding shares outstanding, and we can see they have been going down since 2023 when they issued 150 million share purchase plan. So yeah, if you look at just like this right here for QFIN, which is FINV, FINV has been growing a lot more aggressively, and they have a very healthy balance sheet, which we already went over, and we can see the analysts are projecting very nice growth for both. And back to the presentation. So right here, QFIN, they have reduced 7.9% of the outstanding shares. Fantastic. Again, their solutions, they connect the borrowers to the financial institutions, pretty much the same thing. They don't do house mortgages and very big loans like that. They do much smaller loans. And look at this. Repeated borrowers, 91%, 71% under the age of 40. Annual length of the loan is 10 months, and 81% of the borrowers are from top tier cities, which I believe have higher incomes and better credit scores. And if we keep looking, you can feel free to stop, and I'll put a bunch of links down below. Yeah, they have 52 million users, 31 million repeated borrowers. Very nice growth. Delinquency rate, so loans that have not been paid back. If you look at 2023, I don't know, this is a bunch of different types of loans, but on average it's from 3.5% to 2%, so pretty much the same as FINV. They use AI Argus engine to kind of do the dirty work for them. QFIN only has about 3,000 employees. Again, $730 million in cash, no share dilution. They're doing share buybacks. They have earnings coming out August 19th. So August is a bunch more earnings will be coming out for a bunch of more companies. There'll be a whole lot more videos, and I can't wait to do one on QFIN and FINV again. So you can see repeated borrowers are growing. I gotta really script my videos, but here, one good thing that we like to point out is the delinquency rate. So rates that have not been paid back, loans that have not been paid back, went from 6% 2019 to less than 5% in 2024. So that's one thing they're both doing a great job, is finding better borrowers. And again, FINV, if you look at this, total value returned to shareholders, 600 million since IPO. They have been doing share repurchasing every quarter. And full year 2023, $97 million in share purchasing. They both pay a very nice dividend. And I think both these companies are doing very well. And comment down below if you want to deep dive into one of these companies, or if you want another company. Thank you guys so much for sticking around. And yeah, I don't want to bore you guys with a bunch of this stuff. This is the, I believe, Q1 2024, showing that the profits have been going up, revenues have been increasing, but at a much slower rate. And yeah, so let me know what you guys think. And if you look at the insights on Stock Unlock, both these companies, FINV is given a 3.8% rating out of 5, and QFIN an even better one, 4.2 out of 5. Both have been growing revenues. FINV a little faster, and free cash flow margin of 43% for QFIN. This QFIN is extremely profitable. One thing we don't see here is the share-based compensation, but it's nothing to worry about. I found it in one of the annual reports, and it is going down year over year, only about 150 million or so. There's nothing to worry about. In FINV, share-based compensation is not even a percent of revenue, 8% of operating cash flow. And you can see FINV is also very profitable, just a little less than QFIN, which they are working on, and I believe they will do a great job, which they have been doing a great job, and I will believe they will continue. So that's about it, guys. Thank you so much for watching, and I hope you enjoyed. I'll see you in the next one.